We mentioned in this week's marketing analysis the impact oil prices had on commodity markets like soybeans. Dick Perrin is a professor in UNL's Agricultural Economics Department. He wrote in September the U.S. would soon face a glut of crude oil. With prices already tumbling, OPEC, the 12-member organization of the petroleum exporting countries, decided last week not to alter its production levels. This country, after dramatically scaling up production, recently increased its oil reserves to 36 billion barrels for the first time since 1975. Gasoline prices, meanwhile, are under $2.80 per gallon for the first time since October 2010. We talked with Dick Thursday about the implications of cheaper gas to the U.S. ethanol industry, how OPEC's decision could impact U.S. production, and how steep the drop has been in crude oil prices over the last half of 2014.
Yes, it's been pretty dramatic. It's gone down about a little more than 1/3. Back in as late as 1st of August, we had prices of U.S. petroleum selling for $105. West Texas Intermediate was selling for $105, and today it's selling for $67. So that's almost a 40% drop in 4 months.
So what has contributed to this drop?
There's been a lot of pressure building up over the last few years on the market, kind of a bear pressure, because we've had steady increases in production from a number of world suppliers. Russia has gone up 1 or 2% a year over the last 6 or 8 years. Saudi Arabia, those were the two biggest producers other than us, they went up a couple of percent per year over the last 5 years. And the U.S. has almost doubled our production since 2008. So we've had this buildup of additional supplies tending to push markets down, but there's been a lot of uncertainty. The prices have not fallen very much over that period because of uncertainties related to Middle East tensions and other similar issues. So the result has been it's kind of like an earthquake. We've had these pressure building up, but it didn't break until last week when OPEC met to decide what to do about these burgeoning supplies and slipping prices. And suddenly they decided they were not going to do anything, whereas normally they would have cut back their own production in order to keep prices from falling quite so far. They decided not to do that. They said, let the prices go, and we'll shake out some of these new fresh faces in the market and get them back out of the market, and then we'll be in a long run solid basis for prices again.
Was one of those fresh faces the United States of America?
Absolutely. Most of the experts think that the Bakken fields in North Dakota and the Simeon fields in Texas can continue. Once they've got these drilled, they're going to continue to flow because the big cost is the capital cost of finding the wells and getting them opened and running. That's been done. The oil's flowing. The cost at this point then of keeping them going is not so very high, and so they're expected, I think most people expect our level of production to continue even with prices as low as $55 or $60. Maybe when we get to that point, there might be some reduction.
Some analysts expect gas prices in the U.S. to drop below $2 a gallon. Locally, Nebraska is the second biggest ethanol producer in the country. What effect do lower gas prices have on ethanol production?
Ethanol is a substitute for gasoline, of course, and it won't substitute at a price unless it's lower than gasoline price, because the energy level of a gallon of ethanol is about 70%, about 2/3 actually, of the energy in a gallon of gasoline. So if you priced ethanol on the basis of the energy that it contains, which should translate into mileage, the work that it does, it ought to be about 70% of the price of gasoline. It's been priced higher than that in the past because of mandates and some other issues, but in the last year or two it's been priced close to the 70% level, even sometimes a little bit lower than 70% of the price of gasoline.
So tell me where we go here, short term, and then in a couple years maybe what you think could happen for oil prices.
In the short term, we're going to have gasoline prices around the $2 level, I would guess, through the next year. I could be wrong, but I think that's a very reasonable expectation. and that's going to put a lot of pressure on the ethanol plants. The operating margins will be small. As long as the corn price stays close to $3, right now it's around $3.50, and that makes it a little difficult for the ethanol companies to take $3.50 corn and sell the ethanol for $1.40. They can just about break even on their operating costs. Most plants can, at least. Plants that have high capital payment schedules may have to shut down again, may go out of business again. It'll be pressure, but I think most of the plants will be able to continue operating at the levels they are now. It just won't have a very large margin to pay off their capital debts and so on. So that's the short run story over, say, the next 6 months or so. Longer run, I think the primary expectation is that over the longer run, the economies of the world begin to pick up. Some of these new suppliers, petroleum suppliers, may cut back a little bit on the amount that they're pumping. And the result of those two things, there will be a gradual increase of prices until we get, I imagine 3 or 4 years from now, it would be reasonable to think that we're going to be back around $80 or $90 a barrel for petroleum. That's what I would expect. But the unusual thing is the tensions, the potential for disruptions in supply. Russia's squabbling with Europe about whether they're going to continue to pump oil through Ukraine. We've got Iran sitting in the wings wanting to get back into the world market but can't because of the sanctions. If we resolve our issues with Iran, they can start pumping again. That could be even more oil. So the effect of these disruptions in the international petroleum market are, the potential for those is high. And I suspect that the long-run trend in increasing prices is going to be disrupted by some of those disruptions.
In 1975, the U.S. placed a ban on crude oil exports, but Dick says he believes that ban will be lifted, but doesn't think it'll have the same impact it would have had if it were done a year ago.